What is up, team? Chuck with Traders War Room, and I'm back at you with another video. And we're going to talk about volatility and how it can be your best friend or your worst enemy. But first, I want to invite you to come get some with the team. Join the team and come trade with me. Get all alerts, all live trading, all algos, everything we offer. Guys, quit wasting that money that's not making money. So first, we need to explain what volatility is. So understanding that volatility is the rate at which price of a stock increases or decreases over a particular period of time. Now, higher stock price volatility often means higher risk, but what comes with higher risk comes higher rewards. And guys, I want you to remember a saying: the spoils of war go to the bold, okay? We must be bold when we're out here, specifically trading volatility. We don't get them all right, but the ones that we do get, we want to make sure that we capitalize and make them worth the risk. Another aspect of volatility that we have to understand is how it's calculated. So, volatility is the standard deviation of a stock's annual return over a given period of time, and it shows a range in which the price may increase or decrease. Now, the price of a stock fluctuates rapidly in a short period of time. These are what we see when we hit new highs and new lows, and they can be recent new highs, recent new lows, or they can be overall yearly, annually, or even all-time highs and lows. And it's said to have volatility. If the stock price moves higher or lower slowly, then it stays relatively stable. If it's said to have low volatility, historic volatility is calculated using. So when we talk about volatility, we need to understand how it's calculated. And volatility is a standard deviation or change of a stock's annualized return over a given period of time, and it shows a range in which the price may increase or decrease. Now, if the stock fluctuates rapidly in a short period of time, creating new highs and new lows, it's said to have high volatility. If the stock price moves slower, and it does make highs, it does make lows, but it kind of stays in a slower pattern, then it's expected to be lower volatility. Now, when trading volatility, we want dramatic moves, okay? We want the stock to sharply increase or sharply decrease, and this is what is giving us, as long as we're in the trend of what the stock is going, our best bang for our buck and our rapid returns. Now, this is important to understand. Historic volatility is calculated using a series of past market prices, while implied volatility is looking at expected future volatility using the market price of a market traded derivative like an option. We'll cover more on options later. So when we're looking at trading off of volatility, we need to understand what drives stock price volatility. And there's a few factors that really are key when we're trying to determine what will make things move dramatically. One thing that's really been hitting hard lately is political and economic factors. So governments play a major role in regulating industries and can impact an economy when they make decisions on trade agreements, legislation, and policy. Everything from speeches to elections can cause reaction among investors, which influence the stock prices. And we know this to be true because we see the stock market react violently when these two particular gentlemen decide to get up there and talk about economics and policy changes. Jerome Powell is one of them. Anytime he talks about the FOMC or economics updates, specifically as it, is determined based off of CPI data, GDP data, economy, inflation, anything like that, the markets will react. And the President of the United States, Joe Biden, anytime he gets out there and talks about things that deal with the economy, GDP, or economics, or anything like that, you can rest assured that there's going to be some sort of market fluctuation, specifically when he's dealing and talking about, inflation. He's been talking about oil prices. He's been talking about clean energy initiatives. Things of this nature will make the market shift in specific sectors or the entire market as a whole based off of just a few moments or key items in a speech. Other factors that can cause volatility in the market: industry and sector performances and sector events, right? So specific events can cause volatility within a particular sector. Let's take the oil sector, for example, okay? A natural disaster, a major weather alert can definitely impact oil producing areas and can cause oil prices to either increase or decrease very rapidly. Also, insurance companies and stuff like that. Also, let's think about legislation. We just covered that one, but let's think about legislation specifically to a sector, right? The semiconductor, the Chip Bill Act, right? When we saw that coming into policy and coming in and talking about, a lot of the semiconductors started spiking. And then, of course, when we had, the chip shortage, and then we had issues with, computer slowdown purchasing and earnings purchasing, we saw the semiconductor sector factor in all that and come down as a whole. So definitely we can have some of these cascading events from catalytic events on basically an industry or sector performance as well. Another area is company performance. So volatility isn't just always market wide. It can relate to an individual company. Positive news such as strong earnings report or a new product that is wowing the consumers can make investors look to buy it. This increases demand and raises the stock price. Also, we can see that, some issues with earnings or some events that are showing, negative, performance in that particular company can bring that company down. Now, key thing on this, if they're juggernaut companies, they hold a lot of market space, such as Facebook, for instance, right? Well, we know that when Facebook took a dump, a lot of the stocks that were speculative in nature that were in the same area took a dive as well, because they're looking at, well, Facebook takes a dump, then these other ones got no chance, or they might follow in a similar pattern. So we can see markets fluctuate or sectors fluctuate based off of some big juggernaut companies and their performance. But what I want people to understand is that volatility does not have to mean terrible things, okay? Volatility can be a fantastic tool to utilize to gauge dramatic increases and definitely get us fantastic trades that give us a real great risk versus reward and bang for our buck. Now, investors that have more of a long-term approach towards their trading, maybe even towards the investing side of it, can look at these trends with less concern for volatility, because they're not really concerned about the dramatic shifts going up and down inside of the stock market. In fact, if they're long term and you get a dramatic push to the downside, that might be appealing to them because now they can buy more shares long term. However, traders, we're looking for the momentum and to ride the train on whichever direction that the volatility is going. If it's spiking up hard, we want to ride the hard train going from bottom to top and hopefully peak out at the peak and then maybe potentially ride the rejection to the downside and vice versa. And I get this question a lot dealing with volatility. How can you time volatility? What's the key to it? And really, to be honest with you, you can't time the market. It's extremely hard to time the market, but you can get some ideas on things that are going on. Example, we knew that the sentiment was overall bearish. We knew that companies were going to have some, less than stellar earnings reports. And then we had some of those huge tech earnings that failed miserably, right? Well, we can kind of assume that, all right, if these tech earnings, these big juggernaut companies are not doing so well, we'll probably see a little bit of downward pressure coming on until we find a bottom where we can get support and reject from the bottom. And so we can ride those type of momentum shifts in the marketplace going both upwards and downwards. Right now, like the last couple of days, Thursday and Friday, we saw a dramatic push in the market, okay? We can continue to ride the momentum on the upswing as long as the momentum goes, and then hopefully we can cash out at the peak, and then we can ride some volatility in the shift of momentum back to the downside from rejection at specific resistance points. Now, best days have a huge impact, okay? So when we look back historically, we see that the stock market often corrects itself in 3 downward waves, okay? So this means that investors that exit may miss the best recovery days and the most attractive buying opportunities, which can have significant impacts on longer-term returns, and remaining invested when the markets are volatile usually benefits you in the long run if you're looking at a long-term approach. And this right here goes into the principle of good companies just need time, right? So during economic woes or uncertainty, especially when volatility is high, you're going to see a lot of the wealthy money rotate into more established brands. And that's just because it's a blanket of security. You got more people that are going to feel better about, say, investing in a Microsoft or investing in an Apple rather than going in and investing in B&GO or investing in, say, Peloton based off of previous performance, maybe earnings reports being profitable, and just underlying fundamentals. So that's what it's really going with, is that a lot of people will go to the more established companies as a safe haven to rotate money into. And also, we got to remember catalyst events and the good fundamental companies may see the rotation out of one into the other. You know, Apple's having issues with the China chip shortage or the China factory making iPhones. Microsoft may be the one that they rotate into and see the volume push to the upside. Thorough understanding of volatility and its causes can make investors potentially take advantage of the investment opportunities that it provides to generate better long-term returns. And that's what it's all about, okay? How can I take X amount of money and put it into this particular thing to make X times whatever amount of money in the end, the rate of return. And that's what we want. We want positive, net positive rate of return. We want positive, net positive cash flow. We want all those things on our investments. We don't want to take any type of negative ROI or negative return on equity or anything like that based on our trading. So now we're going to talk about options, right? So there's 7 factors and variables that determine the price of an option, all right? Of these 7 variables, 6 have known values and 1 has an unknown value. And I guess you're going to figure it out because we're going to talk about it. Basically, the current price of the underlying is known. The strike price is known. The type of option, call or put's known. Time of expiration is known. Risk-free interest rate, dividends on the underlying, and the volatility. Volatility is the unknown factor, the implied volatility associated with the risk of what we're trying to trade. So now it's important to understand historical versus implied volatility. Volatility can either be one or the other, and both are expressed in an annualized basis percentage. Historical is the actual volatility demonstrated by the underlying over a period of time, such as the past month, past year, past week, so on and so forth. The implied volatility, and this is the one that we really bank on when we're especially trading, stocks and options and things of that nature, is the level of volatility of the underlying asset that is implied at the current option price. Implied volatility is far more relevant than historical volatility for options specifically because it looks forward. Think of an implied volatility as peering through a somewhat murky windshield, while historical volatility is looking into the rearview mirror. While the levels of the historical and implied volatility for a specific stock or an asset can be and often are very different, it makes intuitive sense that historical volatility can be more important determining of implied volatility, just as the road traversed can give an idea of what lies ahead. And that's important to understand, okay? With all that being said, an elevated level of implied volatility will result in a higher option price, while a depressed level of implied volatility will result in a lower option price. For example, volatility typically spikes around the time a company reports earnings. Thus, the implied volatility priced by traders for this company options around earnings season will generally be significantly higher than volatility estimates during a calmer time. And we see that all the time. Ever seen, Netflix before earnings or a week up in earnings? Implied volatility is already pricing in the premium price, and that's why the contracts are so jacked, because you're expecting dramatic shifts moving into earnings and specifically through earnings of a percentage based off of implied volatility. Understanding volatility in the Greeks is important because the option Greeks are the measure of an option's price sensitivity to implied volatility, and the specific Greek is Vega. Vega expresses the price change of an option for every 1% change in volatility of the underlying asset. 2 points should be noted when regarding volatility. First, relative volatility. Useful to avoid comparing apples to oranges in options market. Relative volatility refers to the volatility of the stock at present compared to its volatility over a period of time. Suppose a stock A is at the money, options expiring in a month, and have generally an implied volatility of 10%, but now showing an IV of 20%, while stock B, 1 month at the money, options have historically had an IV of 30%, which has now risen to 35% over a relative basis. Although stock B has greater absolute volatility, it is apparent that A has a bigger change in relative volatility, and that's what we get into: more bang for your buck. Now, overall volatility in the broad market is also important to consider when elevating an individual stock volatility position. The best known measure of the market volatility is the CBOE Volatility Index, or the VIX, which measures the volatility of the S&P 500, also known as the fear gauge. When the S&P 500 suffers a substantial decline, the VIX rises sharply, and opposite, when the S&P is ascending smoothly, the VIX will become decelerated. Sorry, I meant to say descending. The absolute most fundamental principle of investing is buying low and selling high, and trading options is no different. So option traders will typically sell or write options when implied volatility is high because it's akin to selling or going short on volatility. Likewise, when implied volatility is low, option traders will buy options and go long on volatility. Based on this discussion, here are 5 option strategies used by traders to trade volatility, ranked in order of increasing complexity. Your classic: buying a call or going long. So when volatility is high, both in terms of the broad market and relative terms for a specific stock, traders who are bullish on the stock may buy calls based off the premise of riding momentum or looking for follow through. On that same note, say we want to buy or go long puts, right? The volatility is high, both in terms of the broad market and relative terms in specific stock. Traders who are bearish on the stock may want to buy puts and base off of 2 premises of buying high, selling higher, and the trend is your friend. Right or shorting calls. A trader who's bearish on a stock but thought the levels of implied volatility could recede might consider writing naked calls in order to pocket premium spikes due to volatility. Note that writing or shorting a naked call is a risky strategy, extremely risky, because of the theoretical unlimited risk of underlying stock or asset surges in price. In order to mitigate this risk, traders will often combine a short call position with a long call position at a higher price in a strategy known as a bear call spread. So one of my absolute favorite strategies is the short straddles and strangles. So in a straddle, the trader writes or sells a call and a put at the same strike price in order to receive the premiums on both the short call and the short put position. The rationale for this strategy is that the trader expects IV to abate significantly by the option expiration date, allowing most, if not all, of the premium received on the short put and the short call position to be retained. Now, on the flip side of this, the strangle is similar to a short straddle, the difference being that the price on the short put and the short call position are not the same. As a general rule, the call is above the put strike and both are out of the money and approximately equal from the current price of the underlying. Ratio writing is an advanced strategy, and basically what you're doing is you're writing more options than are purchased. The simple strategy uses a 2-to-1 ratio with 2 options sold or written for every option purchased. The rationale is to capitalize on the substantial fall in implied volatility before the option expiration date. So one of my favorite strategies that I like to use is Iron Condor. And so this strategy, the trader combines a bear call spread with a bull put spread of the same expiration, hoping to capitalize on the retreat and volatility that will result in the stock trading in a narrow range during the life of operation. Real quick understanding of this: basically, the Iron Condor is constructed by selling an out-of-the-money call and buying another call with a higher strike price, while selling an in-the-money put and buying another put with a lower strike price. All right, so wrapping it up here, here's the bottom line, okay? These 5 strategies are used by traders to capitalize on stocks and securities that exhibit high volatility. Since most of these strategies involve potentially unlimited losses or are quite complicated, like the Iron Condor, they should only be used by expert traders who are well versed with the risk of option. Beginners and newer traders should just stick to the old plain vanilla calls and puts. All right, with the main tech video out the way, let's go ahead and get into some upcoming events that Traders War Room has that are real close. On 27 November, we are going to teach you guys how to trade and execute spreads. Now, we talked about some of the strategies earlier in this presentation, but we're not going to go into some of the more complicated ones. We're going to deal with a few different strategies that are proven to be effective, but I'm going to go from the basics to some intermediate spreads, and we're going to cover these type of things. And the glory about spreads is that basically, since you're buying both a call and a put on a spread, essentially, you can take away theta from your trade, right? And so we like that about these spreads, and a lot of them are fun to do. Basically, it's another tool for your arsenal so that you can go out there and attack the market, and that's what it's all about. So I hope to see you guys all in that class. You can always register at the link below, traderswarroom.com. Upcoming classes, guys, and I hope to see everyone there, and we'll look forward to a great class, just like the class we had today. The class we had today went over covered calls, advanced strategies for hedging and leveraging your trades. This will be on the website underneath the historical classes so that you can purchase and view anytime you want to 24/7 for those of you that weren't able to make it live. And I hope you check out a lot of our other classes that we have at traderswarroom.com because we have truly something for everyone. And don't forget to come get some and trade with TWR, guys. Join the team and come trade with me. You get all the alerts, all the live trading, all the algos, everything we offer, guys. And so like we like to say over at Traders War Room, we want you to quit wasting that money that's not making money. We want you to go attack the market with us. And as always, if you're ready, follow me and let's go to war together. Let's get out there and kill it. Hopefully, I see you guys on the trading floor when that bell rings on Monday. Let's go.